everyone, and thank you very much for joining us on this webinar that Rika and Trika are very happy to bring to all of you. And when we were discussing, debating, and for both the businesses that we run, I think the most often asked question we get is, how do we fundraise? What are the ways to do it effectively without diluting a lot of capital? There is a lot of chatter about different methods and modalities in which capital can be raised, and what are some of those, right? And how can we do those effectively without diluting too much of ourselves as founders in the early journey? So we thought, why not just put together a session where we bring in experts to talk about it, where we bring in founders to share their journeys with us, and have a little bit that all of us can take away from this. So the entire hour that we have ahead of us is split up into three parts. We're going to begin with a small introduction to the different sorts of fundraising mechanisms that are available to US founders today: equity, debt, subscription-based financing, revenue-based financing, and what have you. And then we'll try and decode, along with founders, career, iBankers, folks who are from the ecosystem, to try and understand or present you scenarios on what will work for you in different situations and how to go about it. And then we'll conclude with how you can manage all of this better using certain tools, programs that are available and in the market, easily available today. We do want to keep most of this session quite interactive, and you all can use the chat window or the Q&A window to keep posting your questions. What we will try to do is keep integrating those questions in the flow as we go along, instead of trying to bunch up everything at the end. So do post those questions, and it also gives us a good idea of the direction in which you guys would like to drive the conversation, and we'll try our best to get everything answered. So on that note, let me begin by introducing you guys to the first speaker today, and that is Eklavya. Now, Eklavya comes from a background of investing, and now he's wearing his entrepreneurial hat as the co-founder at Trekker. So I do believe that he brings a very good two-sided view to the table, right? Given his experience of having worked in the main street and having helped investors with capital, he is now on the other side to try and see how this entire industry and model can be disrupted to a certain extent. So on that note, let me hand it over to you, Eklavya, and please go ahead and talk to our founders and let them know your thoughts on the investment landscape and alternative methods of fundraising.
Thanks, Saina, and hi everyone. Hope all's well, and good evening. So a little bit about myself, as Saina mentioned quickly, right? I've worked across multiple private equity funds all my life. Obviously, been on the other side, as Saina mentioned. We started this firm now last year, Reka Club, which is here to solve founders' problem of raising capital. So I think we like to talk about different options that are available in today's world to founders, right? Like, people are very lucky. Previously, I think historically there was only one way in which people were able to raise capital. I think times have changed drastically, right? We are living in a very different world, and there are multiple options available to founders today for raising capital. And I'd like to share a few options. Just one second. Apologies, I'm just give me a moment. I'm not able to share my screen. Just give me 1 second, please. Sorry.
If you want, I can project.
Okay, thanks, Abhinav.
Sure.
So basically, the idea being, historically, every founder, you have been getting access to equity capital. Venture capital has been the primary source of go-to capital today whenever you are out there in the market, right? Like when you want to kickstart your business, when you want to lay the foundation of the right team, it's great, right? Like it gives you that leeway, it gives you that freedom to try out things, to build that team, etc. um, and obviously it doesn't come, you know, it does come with certain costs, etc., that we'll talk in detail. But what has happened historically, right? Like when you dilute in early stages, right, which is very important, and it's a must as well, because you need to raise some external capital, which gives you that legway to grow. But over a period of time, you realize that people dilute 20%, 25% in every round. And when they go in later stages, uh, say after 5, 6 rounds, what happens is basically, you know, they are left in almost single digits in their shareholding, right? I don't know if you guys can properly see the screen here. Uh, if you'll see, right, people like Zomato, founders of Zomato were 5.5% at the time of listing, right? Like Policy Bazaar, Pesa Bazaar. Okay, just 1 second, I think.
Yeah, Abhinav, perhaps if you can just refresh the screen. It's stuck on loading to slide view.
Oh, let me try to share again.
Yeah, we are good now. We can see it. Yeah, go ahead.
Yeah, so after all, so yeah, we were saying that, you know, it's a great way to raise capital. It gives you that legway leeway. But if you'll see rough chart here, right, like which we compiled from multiple sources, what happens is you dilute a lot, 20-30% in your initial rounds, and eventually, you know, in this stage we saw that based on the survey, it was around 13% on average where founders are left at the time of their public listing. And some of the recent late stage companies shareholding, if you'll see, right, examples being founders of Zomato at 5.5%, Policy Bazaar 4.3, Delivery 2.2, Farm Easy 1.3, right? Like, so you just see what have you really lost in that journey, right? Like, while I'm sure you have built a great business, but is there a way? Is there an alternate way? I think that's always been the question on top of everyone's mind. People will want this number to be as high as possible, right? And I think in today's world, things have drastically changed. There are certain alternative sources of financing available to the world today, obviously, in particular manners. And just what we talk to founders about is, you know, be very meticulous, be very thoughtful of your early stage dilutions, right? And obviously dilution at every stages. So what alternative financing methods provide today is, you know, like just as a simple forecast of the previous slide, right? Like if you dilute 5% lesser than your previous slide, eventually you end up diluting, you know, more than 10%, less than, you save less than 10, more than 10% of your shareholding, which could be, you know, if you become a unicorn in 5, 6 rounds, it's more than $100 million of net worth that you've actually saved, right? Quite a lot, right? Like once you put that into perspective, you realize what effect does compounding has, right? And we advise everyone to clearly look into different options. So what we thought, we'll quickly compile, you know, what are the different options available today to people and what are the pros, cons for them, high level. Happy to have any questions after this or chat along the way, because I'm sure every one of you has always thought about different options available. Equity, right? It's a great tool capital. I think brilliant way to get you kickstarted, get you to a product market fit. Some of the things, you know, in terms of time to cash in bank is usually longer, right? Obviously comes with certain liquidation rights. But what we tell founders again, right? Like it's not free. People say that I don't have to pay that money back, so it's free. I think that notion has to go away from people, because you are giving heart and soul to a business, right? And you are giving equity for it. So effective IRRs and all the venture capitalists out there, right? Like make great returns. Obviously it's a risky bet and hence these returns. But I think people should really think carefully when they dilute in every round. Alternatives started coming to picture. I think venture debt in India started to become predominant, you know, 8 to 10 years back. A faster way, but it's usually accessible to people, right? Like who have raised marquee capital from marquee VCs, right? Which is you hardly 1 to 2% of the overall startups that run today. So is that a right way, right? Like what have you done wrong? So it's not that a VC comes in and your business changes, right? But that's the way industry was working. There are certain financial covenants or liens charges that they call it attached to it. But even what they do is they take, you know, something called warrants, which are like convertibles that convert into equity at a later stage. So the effective cost, including cost of warrants, is also very high for a fast growing business, right? And these were the two common ways in which people have been financing startups and early stage to mid stage growth companies. What has happened in recent times, you'll see, right? Like there are revenue-based financing for the last 1.5 years, especially in India, and 3 years broadly in the US and other geographies started to come into picture. What it does is it pays you money for your revenue, right? Great idea, because startups have revenue, but they burn a lot of cash, and hence they were, negative cash flow, and traditional sources of financing weren't available to them, right? However, nothing comes free, correct? So revenue-based financing has its end-use restrictions at times, right? Also, the quantum of capital that can be drawn is up to 10 to 15% of ARR. So that's something one needs to really take into consideration when they are raising capital. One thing, right? Like one people have to be very careful in a revenue-based financing product is because how it works is it takes percentage of your revenue as the payment that goes back to the investor who invests, right? So if you are actually growing at say 100% year on year, your actual cost of capital could be very high, or APR or IRR, whatever you want to call it, right? It could be very high. So it kind of penalizes companies for their fast growth, but it's perfect for, I would say, e-commerce brands these days, which have cyclical or volatile revenue. What is the other option that is available? Obviously, Record is doing that as well. So we take proud in what we've done, but why it's very important and very good for founders is, when we saw all these financing options, what was missing was, these are asset light companies, cash burning companies, which are not basic, which were not getting access, or their subscriptions, because the subscriptions and the recurring revenue is a very predictable source of revenue. So what we thought is that, is there a way where you can actually capitalize and make subscription as an asset class, right? And that was a clear answer. So what it does is time to cash in bank has reduced drastically because of the technology play, right? There are no covenants, there are no liens charges. The funding amount can be as high up to 50% of your annual recurring revenue, right? And the cost is usually as a discount of 8 to 12% on an annualized basis. So sounds pretty interesting, right? And it is, right? Like there are people always ask us also when we are out there in the market, what's the catch? We say there is no catch. It's just the way that we value your subscriptions, right? Your subscriptions are pricey. That is what makes you the company you become for a unicorn. So we've just unraveled it at an initial stage. So considering all of these into picture, right? Like how should a founder think about, building the right or taking the right set of financing at what stage? I think that's very important. So I would just like to say 2 cents. There's no hard and fast rule, but typically, right, like a pre-product market fit, when you don't know what your payback period for investment is going to be, it has to be more speculative capital like venture capitalist or equity capital, right? But when you start generating predictable recurring revenues, right, you should definitely, as I was mentioning in the previous slide, spend, and you need to spend in activities like sales and marketing, customer success costs, etc., where the payback period is less than 12 months. I think it has to be a mix of non-dilutive alternative financings like revenue-based and subscription-based financing, depending on your business, and VC capital, right? Like in every round, if you go forward, right, like if you were diluting 20%, as I was showing in the second slide, if you dilute 15% through VCs and 5% to non-dilutive financing, right, like equivalent, you save 100 million plus capital. So just keep that in mind, right? And I think you'll do great as founders. Good luck.
Great. Thanks, Eklavya, for that input. And Abhinav, if you can stop sharing the screen. Okay. So, guys, the next part of this is actually the panel discussion, for which we have Manoj, who's joining us from Zozo Day. Manoj Agarwal is the co-founder of Zozo Day. Zozo Day has been building out for the last almost 10 years. They built out a suite of B2B fintech products for companies to better reward, incentivize their employees, their sales teams, and even their consumers. On the panel, we also have Pranav Mahajani, who is a career iBanker and is now building out Trika Capital, and is responsible for helping founders figure out innovative and good methods for fundraising so that they can focus on their business. Prior to joining Trika, Pranav was with ITI Capital, Citi, Enam, and has helped various classes of promoters, entrepreneurs in their early investing fundraising journey, as well as IPOs and disinvestments. And Abhinav, of course, also joining us from Ricker. Abhinav has been working, he's passionate about products and has been building out that part for Gartner and Opera over the many years and scaling up those solutions. And that's what he hopes to do with Ricker as well. So thank you, gentlemen, for joining us today. And let me actually go to the founder, actually many founders on the panel today, but let's start with you, Manoj. Give us a sense of your early 0 to 1 journey of building out Zozo Day, and if you can do this from the lens of fundraising, right now when you look back at your 10-year journey, what are some of the milestones that at that point of time seemed very crucial, important from a fundraising perspective, and now when you look back and how much things have evolved, what sense do you make of it?
Yeah, thanks, Saina, and uh, thanks everyone to kind of patiently listen to us. So talking about us, see, a startup is a roller coaster ride for every founder. So every day is a new day. Every day comes with a very new challenge. Sometimes it is a known challenge. Sometimes it's a very unknown challenge. Now, there are too many moving pieces as you build your startup. And as a founder, you always try to kind of navigate your path and control those moving pieces so that you can at least fix maybe few of them and then you can focus on the rest. Now, one of the biggest moving pieces around running a startup is to how do you manage your cash flows? How do you manage your working capital? How do you manage the payrolls and the different kind of expenses which the company will incur? And irrespective of the size of the startup or the stage of the startup, there are some costs which you can't ever ignore, or you can't reduce them. For example, anything to do with taxation, anything to do with regular admin expenditures, anything to do with your hiring, where even if you have two guys on your team, you have to kind of pay them. So there are some fixed expenses which are always there with any kind of started right from day one. And then you have to kind of figure out ways how do you handle those expenses. Because when you build a product, depending upon what kind of product you are into, it will take some time to give you revenues, and those revenues will then handle your expenses. So initial days, you will kind of put your own money, or you will raise something from your friends and family, which are those traditional ways of raising capital, the very early stage capital. But typically, when you start progressing in a startup, once you have some customers, some revenue flowing in, that is when you start finding the need of capital much more than what you had in the early days, because now you have got a so-called product market fit. You know that yes, your product is working out there. There are customers who are looking to kind of buy your product, but you want to kind of get into that growth, that okay, today I am having say X revenue, how do I take it to 1.5x, then 2x, and so on. If I have one customer, how can I take it to 2 customers, 4 customers, and so on. And that path requires some kind of funds in the early days, whether it is for your getting some new people on board, or putting some money on the marketing channels, doing some experiments, because not every bet you take in a startup goes in the right direction. Sometimes you will have some failures in some bets. So those are areas where you need funds, and we were no different. So we were also we had our own struggles raising funds at different stages of our life cycle. But as a startup, we have been very, very profit centric as a team. Right from day one, we knew that okay, let's not look at vanity metrics, but let's look at metrics which really matter. And then we made sure that we have some kind of cash flows with us all the time. But we definitely struggled, and I'm talking about the times about say 2012 to 2017, when there were only two popular ways of raising funds. One is equity, and second was the slightly tougher way of raising funds like debt fund, which is largely from banks, or maybe very few venture debt funds, because there are so very few of them. And then both these raises, whether it is equity as well as debt, is very time consuming. I mean, and early days as a founder, you will like to invest your time on your building your business, navigating other things, rather than investing too much or disproportionate time on raising funds. So I mean, those are typical challenges, and I mean, we have gone through those challenges. Try to
Yeah.
raise some equity capital and so on. But
But for the
I
kind
think,
of business that you were building, Manoj, what would, when you look back, do you think that equity financing of capital that you raised by the equity route can be saved or used for certain situations, circumstances, whereas something like, revenue-based financing or subscription-based financing that we're talking about today can be better utilized for certain other consumption needs that a startup has, right? Have you been able
yeah.
to now demarcate those more clearly for your organization, and what is that mix?
Yeah, so number one is, I mean, if you are raising equity in the early days, you might end up losing so much of share capital from your side. I mean, you will dilute a little too much, which is not the best way of raising capital. You will like to preserve your equity, which is your biggest kind of advantage as a founder. So try to preserve your equity in the early days as much as you can, and plus the time as much as you can. And revenue-based financing and some of these new age models around financing, which are from say companies like Recur, Capchase, etc., etc. They are so very DIY. I mean, do it yourself, self-serve models. Uh, uh, it's so very quick. I mean, you don't have to go through say a 3 to 6 month cycle, the way Eklavya explained in the PPT, that it's not so easy. So it definitely makes a lot of sense for startups to kind of raise these kind of capitals like revenue-based financing or invoice discounting, etc. Because this is also like a flywheel, because your revenue growth is actually leading to more growth for you. So
Yes,
yeah, and then it's a very good position to be in, because you are not growing by any external fund, but your revenue is actually helping you grow. So
correct.
you know, it's a great novel idea, and I think startups who are there from in the last 2 3 years are fortunate enough to have these kind of new age funding instruments in their hands.
Okay. On that note, let me come to you, Pranav. You know, the point that Manoj is making about your revenue or your growth fueling your growth further, right? If you have to bring the venture capital lens to this, or, the typical method of raising capital via equity funding, how can one balance this out, right? What is the view that VCs definitely take on, looking at a startup's cap table? What do they like to see there when they look at the MIS of a company? What do they like to see there? And how can better utilization of some of these newer forms of financing early on actually help founders?
Thank you for having me. I think Eklavya has made our life easy with that presentation. I think we don't have to explain much. But having said that, I think if you just step back, Saina, I think you need to look at that any business across the world is assessed purely by how the founder is actually deploying capital. And with changing time, typically we had only equity and pure vanilla debt coming from banks, right? And changing times, we have now very innovative products which are actually helping the founders to look at different alternatives. Okay? But what I would say that just look at day one of your life. When you start making a startup, I think a lot of founders there on the call, and I think it'll be helpful for you guys. When you start
building a startup, I think you should look at yourself, asking yourself that is it a business which is going to require a lot of capital, especially in burning capital? If you require a lot of business, so we have a great fintech, or you have an e-com business, or you're trying to deliver groceries in under 5 minutes, you have a lot of capital to burn over a long period of time, right? Or you have a B2B business where your CACs are lower and you really don't have to spend a lot of time, right? The first phase, I think, is very important, that you raise good quality VC money in first stage of your life, where you have a proof of concept which is not coming. You need money to build your product. You need money. And if you're trying to save that penny there, and if you're trying to live by your Excel sheet, life doesn't work that way. More money in the bank is far more better than no money in the bank. And very important point is that when you want money, nobody gives it to you. And when you don't want it, the whole world lines up, right? So when somebody is giving money, please take it. In the last 17 years, I've done a little bit more than 200 transactions. And I've always seen that when founders want money, koi paisa deta nahi hai. And when they don't want money, the whole world lines up. So I think one is you'll have to focus on doing that. Two is once you are touching probably Series A or you're touching Series B, where you start discussing your monthly run rates. You say my MRR is probably 1 million, 2 million, whatever is that. If you're able to use alternative forms of capital, at that time, you can actually extend and actually buy 1 or 2 months. So, I think, Saina, just to address to your question, what you asked, when a VC looks at this, he's somewhere very happy because he is not deploying the most expensive form of capital. And if he's getting even 1 or 2 months of runway, just because this exercise you are doing. And I would actually see this as some sort of a bridge financing. And obviously, when you get your new capital, you continue this habit. It's like an SIP, and you keep doing this regularly in all the ecosystem what you're trying to do.
Right.
And I think that's something which, as a matter of discipline, it will come over a period of time. I think it's a very important tool to explore.
Okay, nice perspective there. Abhinav, let me ask you to reflect on this, right? From all the use cases that you have seen running Recur as well as your previous experiences, what do you feel is the right point of time? Manoj gave a perspective on it, Pranav gave a perspective on it, to actually explore this sort of financing option. From all the users that use your product already, what are some of the broad assumptions that can be made? And just for all the questions that are coming in after Abhinav takes this one, we will pick up your questions and take it to the different panelists to answer. Yeah, Abhinav.
Thanks. Good evening, everyone. Great. I think definitely, like Eklavya also pointed out earlier, that there are two stages. One is when we are working on the idea, we are actually trying out different things and we are not out there in the market. That is where we essentially need some money. Either we bootstrap it if we have it, or take it from friends and family. That is the time to build. And that is where the speculative capital, where people are taking high risk, and VC fits very well, right? Because we are still not sure of the product. And founders are also themselves not sure on how the market will accept it, right? So that's the phase where VC money or your friends and family capital or your own capital comes in. So as the company grows and as we test their MVPs and they start acquiring customers, that is the time where the idea is started to get validated. And we somewhat try to look at a product market fit, right? And that's the right time to essentially then looking forward, because whenever you acquire your customers, specifically if you're building a recurring revenue business or a B2B or a SaaS business, your customers essentially and retention becomes your power, right? Because your customer love, like we call in product, is everything for the product team, right? Because we want to give them the experiences and we retain them. So it has value. And that is what these alternative financing ways are trying to unlock. That once you acquire a customer and they start loving you, it has value. So your contracts and your customers have value, and why not use and unlock that value? And that's the asset class which we have created, right? Or these new age financing companies are trying to create, that once you start getting revenue or you start getting subscriptions, why not monetize it and raise capital using it? So the right time to essentially start looking at these alternate financing is once you have start to make some revenue. Even the earlier signs, you start to make few customers, 10, 15 odd customers, getting revenue of around say 40, 50K of an annual run rate. That's the time when you know that there is something and we have customers. That's the time to go
Right.
out and then start engaging on these
Okay.
alternative financing.
All right. So there was a question from Mihir on exactly this, that does revenue-based or subscription-based financing work for pre-revenue companies? So thin line there, but I think Abhinav answered that
Yep.
quite well.
Obviously, because they value your customers, so you have to have
Yeah.
some customers who are paying you. That's the validation.
Yeah. All right. The other questions that are coming in, some of them are very specific, but let us look at one question from Abhishek on, does revenue-based financing interfere with any current bank loans or OD facilities that you might be using? So, what is the mix that you can keep with you at any given point of time? Abhinav or Eklavya, if one of you want to take that.
Sure. I can start. So essentially, what we co-work with any kind of existing financing. So what we do is we connect with companies' data and we access them using our underwriting. So that can all coexist. At times, there are certain type of these facilities which have rights on your balance sheets, like or your assets. So at times, a small NOC is required to unlock this financing, but that is always possible. Yeah, so it's not a blocker, but yeah, we have to at times just look at it and then just might take some extra time, so to say.
Yeah. Manoj, you want to come in here and, give in some perspective on, what is your present stack looking like at Zozo Day, right? If you're comfortable sharing, can you give us a sense of, roughly how much do you have in equity financing percentages? How much do you have on your table from other sources, and what you have realized, is a good stack to keep at any given point of time?
Yeah, sure. So I think to clear the air, one is all these instruments of financing can coexist. I mean, they are not like you raise one and the doors are shut for the other. It never works that way. It's again like your portfolio, the way you build your portfolio in a stock market. You can do something very similar here. Depending upon the stage of the business and what kind of capital you are looking at, and the size of the capital. So today we also have a mix of a combination of different capital. In our business, just like Pranav mentioned, we are a B2B business, so our typical requirements of funds are not very high because it's a profitable business. The CACs are not so high, and so on. Most of our fund requirements is around growth and working capital, which we manage with a mix of number one, we have been taking banking, OD, and financing, which has been working very well for us. Second, we are working with Recur for revenue for subscription financing, because our SaaS model basically gives us predictable revenue, and I'm using this word predictable because a subscription-based financing works very well when your revenue is predictable, because you know that, okay, if I'm doing $50,000 this month, I am able to get $50,000 from a financing like Recur. And then we are also having some equity capital. So it's a mix of all the three, and all are working very well, and they are coexisting very well for us.
Okay. Pranav, you have a comment over here to make. I think the other allied question to this is also valuations, right? And when you look at that in conjunction with a dilution that founders might have to undergo, is there a way to shore that up or to extend that using certain other inflows of capital, even if it is equity capital, for instance, bringing in family offices and so on and so forth, to look at you outside of just the typical PEVC venture debt world?
So actually, there are seven forms of capital which can come in at various stages, and quickly cover all of them. When you're just starting a company, you will at that time you'll require an angel investor and a VC who comes in. Typically, that's a seed or an angel round, what typically happens. Then we have series A, B, and C. I think that time we usually have a VC guy coming in, We are seeing a massive practice of family offices who are typically LPs of large VCs are now, there's 600 of them in the country today, and that number is growing. It's as deep as the VC world today, because they're billionaires or people who are large industrialists trying to create their own niche. At that stage, you can start using, your alternative form of investment. At the same time, you can also use debt, in the form of venture debt, or we can call it vulture debt. I think we have to find the right word for it. But yes, we can use that. But as you start crossing your DE, and I think that's when you typically become a unicorn, and that's where, and when you start running out of money, you can go out and do an IPO. And once you do an IPO, once you're listed, you typically have a bank loan where traditional banking system comes into the play, where you can start financing that. But I think the balance is that at each level, optimizing capital, from where it is coming, what is the cost of capital? And always remember that the cost of equity is the highest. See, at the same time, what I don't know, most people are missing this out, is that we are going through a macro trend in the world today, which is changing, where we're getting into a high inflation kind of a scenario. Usually when the inflation goes higher, the cost of debt goes higher, the cost of equity goes higher, discounting goes higher, which brings actually the valuation down. So when that happens, it means that any founder who is jumping between Series A to Series B, he wants to actually extend that time period. And the best way to extend it is either you go to family offices and do bridge rounds with your existing investors, or you look at alternative form of debt, or and that is actually gives you, even if it gives you a 2 or 3 month runway, it will actually save you millions of dollars 3 or 4 years down the line if you survive and if you're able to go to the next level. I think it's very critical to look at this from a landscape perspective.
Okay, perfect. So now I'm going to run through the questions that we have coming in the Q&A window. Let us start from the top. Manoj Patel, right? I think many part question, but the primary one was that are certain industries and certain turnover metrics better suited to subscription-based financing, and what might those be? Also very specific question on, 2CR, what would be the credit amount to clients and so on. So Abhinav or Eklavya, one of you want to take this?
Sure. So basically, in terms of predictability of revenue, right? Like as Pranav and Manoj and Abhinav, all of them mentioned, I think that's very critical. As long as that is established, right? Like usually what we work with, I can tell you, right? Like is, say if you have US $100,000 of ARR, annual recurring revenue, say around $8,000 to $10,000 a monthly recurring revenue, which is predictable and recurring, which we can establish through data. I think that is the stage after which we can work with you guys. There is no limit that you need to be like, 1 million, 2 million, $5 million of ARR, and only then we'll come in, right? Obviously, you need to see that recurring and predictability in that revenue for us to assess. In terms of sectors, I would say, as long as it's recurring, right? It's open. It could be SaaS, D2C, asset subscriptions, OTT players, multiple sectors that one is operating in. And the quantum is not an absolute quantum. It's like a fraction or a percentage of those subscriptions, right? Like usually like we at Recur go up to as high up to 50% of your annual recurring revenue. So if your annual recurring revenue is say 5 crores, all right. So we can go up to 2.5 crores theoretically, right? Like depending on your financial metrics. So it's not an absolute more than a percentage.
Yeah, I think allied question to that, so we can take it now from Anirudh Maheshwari. What kind of interest rates are we looking at for subscription-based financing when compared to a working capital loan taken from a bank? And I think a couple of others also had this question. I think the difference between the two and why opt for this versus knocking on a bank's door.
Sure. You want to take it? So I think first thing is definitely when we work with banks, and I think like Manoj pointed out, is even before we get into rates, it's about the convenience, right? Like Manoj mentioned, do it yourself. So that is the primary most important thing when we consider about engaging with say a VC or say a bank. It takes time. We ensure that it will take around 3 to 6 months, all the documentation and everything. So that's the most important thing. And at this new age financing, we can actually do it within 2 days, right? Because we connect with the system and we can unlock. So it saves a lot of time for founders, and it's technically the fastest way of raising. And then when it comes to say a working capital loan or an invoice discounting, so whenever we look at all these financing, this is the tenure of this financing is very small. It is linked to either the invoice or say a couple of months of working capital loan. right? So whenever this comes in, essentially the quantum which they can get is also lower. So when we look at a subscription-based financing, we are actually kind of discounting up to 12 months of future revenue, which is actually 12 times more than the invoice, like discounting just one single invoice for the next month, right? So the quantum which the founder can unlock from the same asset is up to like 10 to 12x, right? So that is a big difference. And then rates are pretty, I think it depends on, because we are a marketplace, like Klavya mentioned, it depends on the financial metrics, but it tends to be around 8 to 10%, 8 to 12% of the subscription value. So it's very similar to, say, a company which offers an annual discount on subscription, right? So we have seen we get like 20%, 25% discount on annual upfront purchasing for next 12 months. It's very similar that they can, rather than offering this, these companies and founders can come to us and discount much lower, like 8 to 12%, and still get annual revenue from the same contract upfront, right? So that's the tentative cost.
I think another couple of important points here, people is like, if you go to a bank, right, optically it may seem ODs and working capital loans are great, right, which are for sure. Other than the amounts, I think what banks will put in, right, like the hidden covenants, the financial covenants, or the restrictive covenants that come along with it, or your personal guarantees that bank would bring along with it, right, that restrict founders to a lot of extent to actually, maneuver or work the way they want to at the initial stages, because it's not a matured industry that things will go as per plan, this will happen, right? You need that flexibility to do that, which these kinds of models bring in, like ours in the picture, other than bank.
Yeah, personal guarantees and collaterals difficult for young founders, right? Out of college for sure, if you're not starting up after a big corporate stint. Pranav, for you, just club two questions. One from Sandeep Sabat. What is the best and worst case scenario of seed round dilution? Right? Reflect on that and give us, what are the kind of term sheets, if they come your way, you should absolutely stay away from. So best and worst case. And interestingly, with that, you might also want to reflect on Iqbal Heather's question, right? Which is that if one's business model is not a product based, but a services based business, very stable growth in revenues, in that case, what would be the best way to get funds going with any financing option, right? So best worst case, now again, you have a good growing business, but should you really be looking at equity fund? What should you be looking at?
I think let's answer the first question which you asked me, so if you look at some of the best startups in the world, if you look at Google, Facebook, Microsoft of the world, they're not startups anymore, but if you go to day zero of their lives, they were extremely well-funded companies on day zero. They were not started with nothing. The founders made sure that they had some capital. So I would really encourage founders that if you just get up in the morning and have an idea and say, please just start up banate, and if you don't have any money, please don't do that. Because if you do the math, and by the time you're Series D, Series E, you have nothing. And if you realize, you look at Zomato, if the gentleman has 5% of a 7,500 crore market cap company, it means you have nothing. You have actually spent all your life creating value for somebody else. So on day zero, try and pull in some capital from your friends, try and pull in some capital from your family, and try and probably put in some more capital of yourself before you actually start doing anything. Typically, you should have a 10 to 15% dilution on day zero for your seed, because somebody is actually coming in beginning. Sometimes people go all the way up to 20%. Anything beyond that mathematically doesn't make sense. I think what's important is that sometimes people feel, we are seeing some shows nowadays on TV and see, and when you look at that math, it doesn't add up in your mind. And so, series E mein jayega to kya karega? Pahunchega ki nahi wahan tak? You start asking yourself those questions. But I think what is important in day zero is to start having some capital base for you to start, taking on to the next level. So that is one. And two is at every level, I think 2 years back, if you asked me, the dilution was 15%, 20%. Today, at Series B, we see people raising money at $100 million, at $500, $600 million valuations. And the reason that is happening is, on day one, you realize that this is a burn model. So you identify the top 10 VCs in the world who are going to play with you that game. And at every level, they know that if you don't pull the game up on the nth day, then nothing will be left. Right? Because you need infinite capital up to Series E, Series E, F, G till the time you run out of. Nowadays, we see series A1, series A2, B1, B2, because the fear of running out of words. Now coming to the second question, Saina, if you just repeat that question. Yeah, if you're doing profitable business, why you want to raise capital, right? So let's understand one thing, that why do, like, no startups, if you're running a good business, profitable business, don't get into the startup phase. It's not worth it, you know. And I'll tell you why. If you're profitable, if you're cash flow generating, and you'll say, okay, I will just take money to increase my valuation, please don't do that. Because in the real world, it's not happening. If you have a great idea, and if you really want to solve a genuine problem, and you think by raising capital, you will be able to solve it, please go out and only then raise capital. You know, because nowadays people are creating problems and then giving a solution to fix that problem. It doesn't work that way.
Yeah.
The VC world is far, like the angels or some of the family offices we are working with, they're light years ahead. Boss. They look at you and they say, "Ki yaar, ye fraud hai. Isme kuch nahi ho sakta hai." You know, more importantly, look at how big that market is which you're trying to address. And if it is real problem, and I think if there is a real problem, please go out and raise capital. There's a lot of genuine capital available to help you. But don't create a problem.
All right, don't create a problem. Manoj, I want you to reflect on some of the things that Pranav has brought up, and I think I see that as a crux of a lot of the questions that are coming in as well, right? Just the approach to how and what's of fundraising. Why do you need that fundraising? Do you want the valuation? What do you seek out of it, right? Now that we have alternative modes of capital raising available.
Yeah, so one is, I think people do, when they start a startup, they have some or the other goal or dream in their mind, and different people might have different reasons of doing a startup. I mean, most of the time it is about wealth creation for themselves and maybe for their family, most of the times. But there might be some percentage of founders who are doing it for some other reason as well, because they are largely kind of passionate about doing something of their own, etc., and creating employment, etc. So first of all, I think you should be very clear about your purpose when you do a startup. Just as Pranav mentioned, that you are not doing a startup just to prove yourself to somebody or those kind of things, because they won't take you anywhere. So the purpose has to be very clear. Second is, and I keep seeing this in a lot of founders and startups, that you don't start a startup to raise funds. You start a startup to build a startup and create wealth, create employment. So the North Star metric is never raising funds. The North Star metric has to be creating wealth. And then that wealth creation can be of different ways. You do it through the IPOs or M&As, etc., etc. And the third thing is that, I mean, you will know by yourself if you are doing a good startup, that do you really need funds, what size of funds. Just because there is a lot of noise in the market, everyone is raising funds, you should not get into that cycle of raising funds. If you need, let's say $10 million, I mean, then go after the $10 million kind of a fundraise. Don't chase $100 million, because maybe you may not need it. And then even with smaller fundraisers, you can build great companies. And one great example is Google itself. If you see Google, one of the best companies where the founders still have huge share capital, just because they raised very, very small capital in the early days. So don't just get into the rat race of raising capital. Just raise capital in terms of the size which you need. And if you are doing a good review of your financials, and if you are very meticulous in checking your metrics, etc., I'm sure that you won't get into that vanity of raising capital just to do the PR and just to talk all those Zoomlas here and there. I mean, not required.
Right. Okay. All right. Thank you very much, Manoj, for that very candid speak. I think we'll just take another question or two. There is a very detailed question from Bharat that has come in, Eklavya. Perhaps you guys can, Bharat, we try and connect you to the folks at Trekker, and you can take it up with with Abhinav and Eklavya offline. But I think the last question that we'll take and then move on to the next piece, which is how does revenue-based financing or subscription financing, does it sit as debt on a balance sheet? How do you account for it? Just, I think, some nitty-gritties on how it actually works in real life.
Right. So quickly, revenue-based financing, how it sits is like that. That's correct. But how subscription-based financing, what we have created, obviously, it is not like a debt like a product. It is not equity, not debt. So it's kind of a new asset class that we were saying. So that obviously we can collect separately, but it sits as a short-term liability on your books, but not as a debt, effectively.
Okay, all right. Thank you very much, Pranav, Manoj, for joining us today and sharing your input. So we've spoken a lot about, raising the capital. The other part that we did want to address as part of this webinar is, now that you've raised it, how do you manage it? Correct? And how do you do that effectively so that you have good visibility, not just for yourself, but also for your team members that might be involved, your investors that might be involved, and to give you a little bit of a glimpse on what effective management of equity or revenue-based financing or debt and how it looks on your cap table. I'd like to invite Webher from the Tricar team to give us a little bit of an overview and sense of how you can work with Tricar to better manage your equity. Webher?
Thanks, Saina. I'll just quickly share my screen and take everyone through the Trica Equity platform and how it's easy for them to manage. So Trica Equity, we help you manage the entire shareholding patterns, whether it is your shareholders or your ESOPs employees. There's a single platform for you to manage the entire structure. We currently engage with more than 500 plus customers, out of which 30% of them are Series B plus companies. We also have around 11 unicorns working with us. And some of our notable names are Homelane, Wildcraft, as you can see on the screen. Now, what we get on board is a totally paperless solution, whether it is your SACE certificates that needs to be issued out or the grant letters. We provide a platform where you can issue these, get this signed from both the parties from a single platform, a single source of truth. So for all your shareholders and your employees with ESOPs, you can use the platform to manage all of that. We also help you with ESOP liquidity functions, whether you want to arrange liquidity for your employees. Our wing Trica Capital can come in and arrange that liquidity. We have around 700 plus investors sitting on deck to have that liquidity arranged and take the shares from those employees, right? As part of Trica, we consider security as very critical. We have ISO 27001 security certificate, which ensures the international security parameters. We handle companies from India, US, as well as the Singapore. So we take all the accounting standards and the compliance standards from there. In terms of reporting, you can generate multiple reports from the platform, whether it is a customized report that is required, that can also be easily generated. In terms of the commercials, we are very cost effective. We don't charge you till 100 users. The only charge that we take is a nominal onboarding charge. And if the company is at a level of Series A or Series B or have more than 100 users, we only charge 500 rupees per user per year. I like to show you the entire interface of how you can manage your cap tables from the portal. As you can see on the screen, we have a shareholder-wise overview and the round-wise overview of what amount of equity that you diluted in multiple rounds that your company has seen. In the investor-wise, you can see what all investors have joined you, what is the percentage shareholding that they have. In the round-wise, also you can check at what amount of investments were diluted in what particular round, who all have joined you in what particular round. So the tool encompasses all the different parameters. If you want to see your historical view of your cap table, that can easily be seen. If you have raised multiple rounds and now you want to download your cap table based on a particular round, you can simply select the funding round, or on a particular date, if you want to track your cap tables, that can easily be done. We also support in round modeling or a scenario modeling function wherein you want to see your hypothetical cap table, which is not typically suited if you're doing on an Excel file, which can easily be rectified and can be managed from the portal. All the different securities, whether it is equities, ECPS, we spoke about different ways to generate funds. All these securities can be added and can be managed from the platform. The different sets of shareholders that you have, the different funding rounds that you have raised, all this information can be available on the platform. Saina, do you want me to take them through the ESOP? Do we have time for the ESOP management portal as well?
Yeah, I think we can just look at a short overview, and yeah, I think this is pretty much what people will need to see in terms of managing your ESOP pool quite effectively as well using the product.
Right. So in the ESOP management, we can support the ESOP, SARs, and RSUs that you must have distributed to your employees. If you have multiple schemes running, we can manage all of that. The entire pool size that you have created, the options that you have granted, if you have granted options, you want to see what is the grant and what grants have happened in the past, all that can be seen from the portal. And this is the admin view that we are looking at. We also have a shareholder-wise overview, or the shareholder-wise view and the employee-specific view, so that they also have their own dashboards to look into what amount of investments that they have made in your company and what amount of ESOPs do they hold in your company.
Great. Thanks a lot, Webhub, for that and taking us through this portal. Again, just wanted to let everyone know that for everyone who's attended the webinar today, you can look at Trika Equity and have a flat 50% off on all onboarding fees. For those of you that are looking to explore the Recur offering more closely, we have Eklavya and Abhinav who are still with us, and I know there are still some unanswered questions. So if Eklavya or Abhinav can stay on for a few more minutes and answer those, nothing like it. Manoj, thanks a lot for spending the hour with us. We really appreciate the time that you've put in here today. Thank you very much.
Thanks, Saina.
Thank you. Thanks, Manoj. Eklavya, I think we still have few people who are here with us.
Yeah,
but
sure.
So if you can just go through some of the questions and
Sure.
just pick up few that you would like to answer. Nothing like it.
Sure, Saina, I'll do that. So I'll go by the Q&A. I think the first one I see here when open is Ashutosh, what is subscription-based financing? So I think it's, assume that your subscriptions or your recurring revenue, you get capital today, like as if your customers have paid you all today at a particular discount, which is around 8 to 12%. As simple as that, right? Like the money that you were supposed to receive in the next 12 months is being fast forwarded as of today. That is what subscription-based financing is. So you get capital based on your subscriptions without dilution, which you can use for your growth, working capital, customer acquisition, sales and marketing, whatever you want to do. I think invoice discounting and revenue-based financing, Abhinav answered that very well, so I'll skip this one.
Yeah.
On the slide, yeah, percentage of ownership, like usually, obviously, what we showed there, it's a public information, so I think it's no rocket science there, but broadly it is, you will look at it. Anything particular that you want to ask here, please feel free to write a question again or get in touch separately. I think next one we see here is by Vinil. Yeah, I think this one was answered by Pranav, right? Like in terms of cash burning. In terms of subscription-based financing, I can tell the audience, because you are cash burning and hence you don't have access to, traditional banking sources, as Pranav mentioned, during your IPO stages or post-IPO stages. And that is where we come in and value, your subscriptions and your revenue or recurring revenue and give money against that. I think the next one here is by Bharat. I think we'll get in touch with him separately. But Bharat, just in case, just to answer broadly, right? Like it's a trading limit that we give you, right, as a platform, which you can use again and again for redeeming your capital. It's not like a one-time limit when you're growing and using our capital, right? In this example, you will actually deploy that capital in growth and it will regenerate more revenue, right? And more profits, etc. And hence we will be able to fund you more. So it's like a cycle or a flywheel that you get into, and you can generate more capital and we can partner for you for, for your life journey. I think Ashutosh's question was answered, that pre-revenue kind of thing.
Yes.
So post-revenue.
Yeah, I think lots of questions around the pre-revenue piece, Eklavya. So I think maybe if you can spend a couple of minutes just to explain the model a little better, I think that might help a wider audience.
Tour also, yeah. So basically, like if you are pre-revenue, obviously we can't do anything, right? You don't have paying subscriptions and to that extent, right? So what we look for, what companies, even I've seen like, companies abroad also doing it, right? Like when you have predictable recurring revenue, you don't need to have like, $1 million ARR. 100,000 ARR, which is like 8 to 10,000 of monthly recurring revenue from your contracts or your clients. I think that is when companies start coming into picture and see, okay, we can really value these subscriptions, say, because that is what we are paying you money for, right? Like we are not taking a bet that you will grow and we will take your upside. All your upside, all your equity remains with the companies and the founders, right? So obviously there are institutional investors that invest in these, right? Like, so they have to be comfortable. There's no free money in that world, right? Let's be very frank and honest, right? Like, but they are valuing your subscriptions because they are predictable and recurring, right? So till the time one can really agree to that point, right? Like, or maybe establish that point that, okay, that's it. I think that is when it comes, platforms like ours would start coming into or being useful for people, founders.
Okay. All right. And I think with that, we've gone through all of the questions that people had for us. Thank you very much, everyone, for joining us. Like I mentioned, we will be in touch with you all for both Recker as well as Trica Equity. If there are more questions on the Trica Equity side as well on how you can use the product to better manage your cap table and ESOPs, I'm here. The rest of the team is here as well, and we'll be happy to answer your questions on that front as well. How you can more effectively use things around, round modeling, or even the piece on looking at your fully diluted cap table, managing your investor communication, and so on and so forth. So yes, happy to be here and help out in any way.
And I think we used the Trica product a couple of weeks back, and I think it was phenomenal. I think it was pretty solid. It saves all our lives working around different Excels. So I think pretty useful. I definitely like to compliment you for that.
Thank you very much. I saw there was a point over there on Microsoft, and I'm just thinking, all of us trying to get the world out of Excel sheets. What bodes for Microsoft? Yeah. So thanks, everyone. I think we don't have more questions coming in. So thank you, Eklavya. Thanks, Abhinav, for making the time today. And like I said, we will be in touch with all of you, and feel free to ping us to understand more about alternative financing, even mainstream financing, if that is what you require. And then, of course, the Trica piece to help you manage everything better. Thank you.